So the second financial statement is retained earnings or statement of retained earnings. So it shows the portion of net income reinvested into the business. What was the formula? We have beginning retained earnings plus net income minus dividend or the amount that is distributed to the shareholders from the profit. We call that dividend, and this is equal to ending or end period retained earning, right? So retained earnings means exactly what the term implies, which is the portion of net income that a company has kept over a period of years. If historically revenue exceeded the expenses, the result will be a positive balance in the retained earning. Why? Because revenue minus expenses, if expenses decrease, revenue increase, so there's going to be a positive number that would be added into the beginning retained earning, and the answer would be increased retained earning at the end, right? So when there is an income, it increases the retained earnings. When there is a loss, it decreases the retained earning. So net income flows from the income statements to the statement of retained earning, right? First we make the income statement. From there we find out the net income, and then we make the retained earnings. Why? Because in retained earning retained earnings statement we will be using our net income figure. So the tagline here for the dividends are that the corporation not obliged to pay the dividends, which means it is not must for the organization or required by the law to always pay the dividends. Companies sometimes uh, do not share the profit with the shareholders. Why? Because they can see the the foreseeable future, that in future they would be needing money, so they accumulate, or they or accumulate the profit from time to time, and whenever they need that money, they just invest, rather just issue new shares to the public or ask for loan, right? So the statement here shows the retained earnings, retained earnings statements. So retained earnings statement starts from the beginning year retained earning, and then we add the net income. So you see beginning year is 2010, ending year is 2011. You add the income and you minus the cash dividend for the year. So these years are same. So we have the retained earning at the end of 2011, plus in 2012 we add the net income, and then you less the 2012 cash dividend you paid in 2012. That would be the answer here, right? So these are the retained earnings at the end of the year 2011 and 2012. And now coming towards the balance sheet. So the balance sheet measures the financial position of a company at a specified date. So this also called the statement of financial position. So it reports the accounting equation, which is assets, liabilities, and stockholders' equity. So it dates at the moment in time when the accounting period ends. For example, if accounting period ends at 31st December, so it shows the position of the company at 31st December. Okay, let's talk about the assets on balance sheet. So assets are categorized into two main categories. One is current assets, the other is long term or fixed assets. So now we'll talk about current assets. So current assets whose life is like less or equal or less than 1 year, or the perfect definition is it is expected to be converted into cash, sold or consumed during the next 12 months or within the business operating cycle if more than 1 year. So normally business cycle is 1 year. So when it starts and when it ends, it depends on the countries or industry norms. Normally, companies they started their business operation from January and last till December. But similarly, the other governments, for example, if I talk about the Asian countries or Asian Pacific countries like India and Pakistan, so they start their the governments they start their June to June or 30th June, right? 1st June to 30th June, right? So it depends. If it's more than 1 year, the operation cycle is 1 year, then this definition is changed. It doesn't include 12 months. Okay, let's talk about the subcategories or sorry, categories of current assets. What things are included in current assets? Number one is cash, cash and cash equivalents, short-term investments, accounts and notes receivable, inventory and prepaid expenses. So let's talk about the cash and cash equivalents. Definition of cash is that it is the liquid assets that's the medium of exchange. Right now, for example, the currency, coins. For example, if you're in China, then yuan is considered as cash because the face value of 100 yuan is equal to 100 yuan. If you present 100 yuan to a shop, he will give you 100 yuan's equivalent of goods, right? That is cash. Cash equivalents means like you have golds, you have dollars, you have bonds, you have Canadian dollar, in which there is some, they are also considered as cash, but there is a little bit, you can say that uh, mm, easy convertibility, because if you present $100 bill to a shop, he will accept, but that doesn't mean that the other person he will accept the same amount of goods and services for $100. So there is a difference between cash and cash equivalents. So cash equivalents include money market accounts or other financial instruments that are easily convertible to cash. Or for example, you have a bond, you are selling the bond into a market. So the government bond, it will be ready to or they will say that okay, you present 100 yuan short-term government bond, and the guy is ready to give you 99.8 yuan. So it's almost 100 yuan, right? So that's called the equivalence. It includes the gold coins, silver coins, or financial instruments, money market accounts, right? Let's talk about the